I get asked constantly about hedge fund strategies. People want to know how the professionals make money. They want to know what secrets Wall Street is hiding. They want to replicate what the big funds do. And I understand the appeal. Hedge funds have produced some of the greatest investors in history. They manage trillions of dollars. They attract the smartest people in finance. Surely they must know something the rest of us do not. But here is the truth that nobody wants to tell you. Most hedge fund strategies cannot be copied by retail investors. Not because they are too complex to understand, though some are. Not because they require special knowledge, though some do. The real reason is structural. Most hedge fund strategies require resources, access, and scale that individual investors simply do not have. Let me walk through the major hedge fund strategies and explain why each one is inaccessible to individual investors. Short selling on margin with prime brokerage relationships. When a hedge fund wants to short a stock, they call their prime broker who locates shares to borrow. The prime broker maintains inventory of shares available to short and has relationships with custodians and institutional shareholders who lend their shares. The borrowing costs are negotiated based on the fund's size and relationship. You do not have a prime brokerage relationship. You use a retail broker that offers limited short inventory at higher borrowing costs. You face more frequent short squeezes because your broker can recall shares with limited notice. The structural disadvantage makes short selling far less effective for retail investors. Convertible arbitrage requiring massive positions to capture tiny spreads. This strategy involves buying convertible bonds and shorting the underlying stock to capture pricing inefficiencies. The spreads are often measured in basis points. To generate meaningful returns from basis point spreads, you need massive position sizes. A fund might need to put on a $100 million position to generate a meaningful profit. You cannot do this. And the financing costs for smaller positions would eat up any potential profit. The strategy simply does not work at retail scale. Merger arbitrage needing real-time access to deal flow and legal expertise. When a merger is announced, the target company's stock typically trades at a discount to the deal price, reflecting the risk that the deal might not close. Merger arbitrage funds buy the target stock and capture this spread when deals close. But to do this effectively requires real-time access to deal announcements, legal analysis of deal terms and regulatory risks, and the ability to build positions before the spread narrows. Hedge funds have teams of lawyers and analysts dedicated to merger analysis. They have direct relationships with investment banks that give them early intelligence on deal flow. You have none of this. Statistical arbitrage, running thousands of simultaneous positions with millisecond execution. These funds use quantitative models to identify small mispricings across thousands of securities and execute trades in milliseconds to capture these spreads before they disappear. They co-locate their servers next to exchange servers to minimize latency. They employ teams of PhDs to build and refine their models. They spend tens of millions of dollars on technology infrastructure. You cannot compete with this. By the time you see a statistical arbitrage opportunity, it has already been captured by funds with faster systems. Credit trading with direct access to bond dealers. The bond market is far less transparent than the stock market. Bonds trade over the counter through dealer networks. Large institutions can negotiate better prices and access bonds that retail investors cannot even see. Credit hedge funds have direct relationships with the major bond dealers. They see inventory before it is publicly available. They get better execution and access to new issues. Retail investors trade bonds at massive bid-ask spreads through retail platforms that offer limited inventory at inferior prices. Distressed debt requiring the ability to participate in bankruptcy proceedings. The best distressed opportunities often require becoming a significant creditor and participating actively in restructuring negotiations. Hedge funds buy large positions in distressed debt, sometimes enough to control the bankruptcy outcome. They hire bankruptcy lawyers and restructuring advisors. They negotiate with other creditors and with management. This requires scale, expertise, and the ability to deploy teams of professionals over multi-year processes. Individual investors cannot participate meaningfully in these processes. But there is one hedge fund strategy that retail investors can copy. One approach that requires no special access, no prime brokerage relationships, no sophisticated infrastructure. One strategy that has produced some of the greatest returns in investment history. And ironically, it is a strategy that most hedge funds have abandoned because it does not scale well and does not generate the fees they need to justify their existence. That strategy is deep value investing. Concentrated positions in deeply undervalued securities, held with patience until the market recognizes their worth. It is what I did at Scion Capital before the housing trade. It is what made my early reputation. And it is entirely accessible to anyone willing to do the work. Let me explain why deep value investing works, why most professionals have abandoned it, and how you can implement it yourself. Because this is genuinely the only hedge fund strategy that translates to retail investors without losing its effectiveness. The foundation of deep value investing is simple. You buy assets for significantly less than they are worth, and wait for the market to recognize the true value. The gap between price and value is your margin of safety. The wider the gap, the greater your potential return, and the lower your risk of permanent capital loss. This sounds obvious. Buy low, sell high. Everyone knows this. But the execution is far more difficult than it sounds, which is why most investors fail at it despite understanding the concept perfectly well. The first challenge is actually determining what something is worth. This is where most investors go wrong immediately. They confuse price with value. They think a stock that has fallen 50% must be cheap. They think a stock trading at a low price-to-earnings ratio must be undervalued. These are dangerous shortcuts that lead to terrible outcomes. A stock that has fallen 50% might still be overvalued if the business has deteriorated. A stock with a low price-to-earnings ratio might be cheap for good reason if earnings are about to collapse. Price tells you what the market thinks today. Value tells you what the business will generate over time. These are entirely different concepts. Let me explain how I think about value. The intrinsic value of any financial asset is the present value of all future cash flows that the asset will generate. For a business, this means projecting out how much cash the business will generate over its remaining life and discounting those cash flows back to today at an appropriate rate. This sounds theoretical, but it is the foundation of all proper valuation. The practical challenge is that future cash flows are uncertain. You do not know exactly how much cash a business will generate 5 years from now or 10 years from now. You have to estimate, which means you have to understand the business well enough to make reasonable estimates. The more predictable the cash flows, the more confident you can be in your valuation. The less predictable, the wider the range of possible values. This is why I focus on businesses I can understand. I want businesses where I can reasonably estimate future cash flows. I want businesses with stable, competitive positions, recurring revenue, and predictable cost structures. Businesses with highly uncertain futures, even if they might be undervalued, are difficult to own with conviction because the range of possible values is so wide. Determining true value requires understanding the business. What does it actually do? How does it make money? What are its competitive advantages? What are the threats to those advantages? How much cash can it generate? How predictable is that cash generation? What are management's incentives? How have they allocated capital historically? Let me walk through how I analyze competitive advantage because this is crucial to valuation. A business with durable competitive advantage can sustain margins and returns on capital over time. A business without competitive advantage will see margins and returns competed away. The difference in value between these two types of businesses is enormous, so understanding competitive position is essential. There are several sources of competitive advantage. Cost advantages from scale, proprietary technology, or access to inputs can allow a company to underprice competitors while maintaining margins. Network effects, where the product becomes more valuable as more people use it, create switching costs that lock in customers. Brand recognition can command premium pricing. Regulatory barriers can prevent new entrants. Switching costs can make it painful for customers to leave. When I analyze a business, I try to identify what competitive advantages it has and how durable those advantages are. A company trading at a low multiple might deserve that low multiple if it has no sustainable competitive advantage. The low multiple reflects the market's accurate assessment that margins will be competed away. Buying such a company is not value investing. It is value trap investing. These questions cannot be answered by looking at stock charts or reading analyst reports. They require reading annual reports, quarterly filings, proxy statements, industry publications, They require understanding accounting well enough to see through the games companies play to make their numbers look better. They require building financial models and stress testing assumptions. They require thinking independently about businesses rather than relying on consensus opinions. This is work, real work, hours and hours of reading and thinking about individual companies. Most people do not want to do this work. They want a shortcut. They want someone to tell them what to buy. They want a stock tip or a newsletter recommendation. And this is precisely why deep value investing continues to work. The edge comes from doing work that others are unwilling to do. The second challenge is having the patience to wait. Markets can remain irrational for extended periods. A deeply undervalued stock can stay undervalued for years. The catalyst that closes the gap between price and value may take far longer to arrive than you expect. During this waiting period, other investments might be rising. You will feel stupid for holding an underperforming position. You will be tempted to sell and chase whatever is working. This is where most value investors fail. They do the work. They find genuinely undervalued companies. They buy at attractive prices. And then they sell too early because they cannot handle the psychological pressure of waiting. They rotate into something else just before the original investment finally works. The returns from value investing come from patience, and patience is the scarcest resource in financial markets. The third challenge is position sizing. Deep value investing works best with concentration. If you find a genuinely undervalued company trading at 50 cents on the dollar of intrinsic value, you want meaningful exposure. A 2% position will not move the needle on your portfolio even if the stock doubles. But concentration requires conviction, and conviction requires doing enough work to truly understand what you own. Most investors diversify because they are uncertain. They own 30 or 50 or 100 positions because they do not know which ones will work. This is a reasonable approach if you are not doing deep fundamental work. But if you are doing the work, if you truly understand a business and believe it is significantly undervalued, concentration makes sense. The best returns come from having meaningful positions in your highest conviction ideas. Let me tell you how I implemented this strategy at Scion Capital in the early years, before the housing trade dominated everything. I would screen for companies trading at low multiples of book value, low multiples of earnings, or low multiples of free cash flow. This gave me a universe of potentially cheap stocks to investigate. Then I would read the filings. Every company that passed my initial screens got a deep dive. I would read multiple years of annual reports. I would read the footnotes, which is where companies hide the bad news. I would read the proxy statements to understand management compensation and incentives. I would read the quarterly transcripts to see what management was saying and whether they were consistent over time. Most companies that looked cheap on the screens turned out to be cheap for good reason. The business was deteriorating. Management was extracting value rather than creating it. The balance sheet had hidden liabilities. The competitive position was eroding. Maybe 90% of the companies I investigated went into the reject pile after deeper analysis. But occasionally I would find something genuinely mispriced. A company with a solid business trading at a discount because of temporary problems. A company with hidden assets not reflected in the stock price. A company where the market was extrapolating recent bad news into perpetuity when the situation was actually improving. These were the opportunities. When I found these opportunities, I would build meaningful positions. Not 2% positions, 10% positions, sometimes larger. Because if I had done enough work to have genuine conviction, I wanted that conviction reflected in my portfolio. The concentration created volatility, but it also created returns. The best years at Scion came from having large positions in ideas that worked spectacularly. The holding periods were often measured in years, not months. I would buy a deeply undervalued stock and wait. Sometimes the market would recognize the value quickly, and I would have a fast profit. More often, I would wait a year or 2 or 3 for the thesis to play out. During those waiting periods, the position might decline further. It might underperform the market significantly. But if my analysis was correct, eventually the value would be recognized. This approach is entirely available to retail investors. You can read SEC filings for free on Edgar. You can access company annual reports on their websites. You can build spreadsheet models on your laptop. You do not need a Bloomberg terminal or expensive data subscriptions. You do not need prime brokerage relationships. You do not need access to management. You just need to be willing to do the work and exercise patience. In fact, retail investors have structural advantages over hedge funds in deep value investing. Let me explain why. First, there is no redemption pressure. Hedge funds have investors who can withdraw capital. When performance is poor, investors redeem. When investors redeem, the fund must sell positions, often at exactly the wrong time. This forces hedge funds to care about short-term performance even when they know the long-term opportunity is compelling. You do not have investors. You cannot be forced to sell by anyone except yourself. You can hold through the difficult periods without external pressure. I have seen brilliant hedge fund managers forced to close positions at the worst possible time because their investors lost patience. They had done excellent fundamental work. They had identified genuinely undervalued securities. They were right about the thesis. But they could not survive the period between when they were right and when the market recognized they were right because their investors redeemed during the difficult stretch. As a retail investor, you do not face this risk. Your only enemy is your own impatience. Second, there are no asset gathering incentives. Hedge funds make money on management fees, typically 2% of assets. This creates an incentive to gather assets, which means marketing to potential investors, which means needing a track record that looks good quarter by quarter. A hedge fund that underperforms for 2 years, even if the positions eventually work spectacularly, will lose investors and shrink. This pressure pushes hedge funds towards strategies that generate consistent returns rather than strategies that generate the highest long-term returns. You have no such pressure. The asset gathering incentive is particularly problematic for value strategies. Value investing is inherently lumpy. There are periods when value stocks underperform growth stocks, sometimes for years at a time. A hedge fund running a value strategy during a growth-dominated period will see redemptions even if their long-term thesis is sound. This pushes managers towards strategies that produce smoother returns, which often means lower long-term returns. You can optimize purely for long-term wealth creation without worrying about smoothing returns. Third, you can invest in smaller companies. Hedge funds managing billions of dollars cannot take meaningful positions in companies with market capitalizations of a few $100 million. The positions would be too small to matter to the fund, and the liquidity would be insufficient to build and exit the position. But small companies are often where the best opportunities are found. They are less covered by analysts. They are less efficiently priced. The gaps between price and value can be enormous. As a retail investor, you can access opportunities that are structurally unavailable to large funds. This is a significant advantage that is underappreciated. The efficiency of markets is directly related to the amount of analytical attention a security receives. Large cap stocks are covered by dozens of analysts. Every piece of information is analyzed within minutes of release. It is very difficult to have an informational or analytical edge. But small cap stocks might be covered by 1 or 2 analysts, or none at all. Information takes longer to be reflected in prices. Patient investors who do their own work can find significant mispricings. I have found some of my best opportunities in companies with market capitalizations under $500 million. These companies are too small for most institutional investors to consider. The trading volume is insufficient for hedge funds to build meaningful positions. But for an individual investor putting in $100,000 or even $1 million, the liquidity is adequate. You can build a full position over a few weeks and exit over a similar period. The small size that makes these companies uninvestable for institutions makes them ideal hunting grounds for individuals. Fourth, you have no career risk. A hedge fund manager who underperforms for an extended period loses their job. This creates pressure to hug benchmarks, to avoid positions that might look stupid if they do not work, to prioritize not looking bad over maximizing returns. You have no career to protect. You can make investments that look unconventional or contrarian without worrying about what others will think. The career risk issue is particularly important for contrarian investments. The best value opportunities are often in hated companies, companies that everyone agrees are terrible, companies where the conventional wisdom is overwhelmingly negative. A hedge fund manager who buys such a company and is wrong faces severe career consequences. They will be criticized for ignoring the obvious problems. They will be questioned about their judgment. Even if they are ultimately right, the short-term career risk may outweigh the long-term return potential. You face no such constraints. You can buy the most hated company in the market if your analysis suggests it is undervalued. Nobody will fire you for being wrong. Nobody will question your judgment publicly. You can afford to be wrong on individual positions because you have no career at stake. This freedom allows you to pursue opportunities that professional investors must avoid. Fifth, you do not have to report positions quarterly. Hedge funds with more than $100 million in assets must file quarterly reports disclosing their holdings. These filings are analyzed by competitors, journalists, and other investors. Positions become known. If a fund is building a position in an illiquid stock, the quarterly disclosure can move the price against them before they have finished building. You have no disclosure requirements. You can build and sell positions without anyone knowing. These structural advantages are significant. They explain why deep value investing, properly implemented, can actually work better for retail investors than for hedge funds. The strategy does not scale well, which is why most hedge funds have abandoned it. But the reasons it does not scale, small companies, concentrated positions, long holding periods, are not problems for individual investors. They are opportunities. Let me give you some specific techniques for implementing deep value investing. Start with screens, but do not trust them. Screens are useful for generating ideas, for finding companies that might be undervalued. But the screen is just the starting point. Every company that passes your screen needs fundamental investigation before you invest anything. I like screening for low price to tangible book value. Tangible book value is total equity minus intangible assets like goodwill. A company trading below tangible book value is theoretically trading for less than the liquidation value of its hard assets. This does not mean it is automatically a good investment, but it does mean it is worth investigating. I also screen for low enterprise value to EBITDA. Enterprise value is market capitalization plus debt minus cash. EBITDA is earnings before interest, taxes, depreciation, and amortization. This ratio tells you how many years of current cash flow it would take to buy the entire business, including its debt. A ratio below 5 suggests the company might be cheap, though again, investigation is required. Free cash flow yield is another useful screen. This is free cash flow divided by market capitalization. A high free cash flow yield means the company is generating significant cash relative to its stock price. If that cash generation is sustainable and the company is allocating capital wisely, a high free cash flow yield suggests undervaluation. Once you have screened for potential opportunities, the real work begins. Read the most recent annual report cover to cover. Do not skim. Read every word, including the footnotes. The footnotes are where companies disclose information they are required to disclose but do not want to highlight. Related party transactions, contingent liabilities, pension obligations, off-balance sheet arrangements. The footnotes tell you what management is trying to hide. Then read the previous 4 years of annual reports. You want to understand how the business has evolved, whether management statements have been consistent, whether their predictions have been accurate. Management that consistently overpromises and underdelivers should be avoided. Management that is honest about problems and realistic about prospects is more trustworthy. Read the proxy statement to understand management compensation. Are executives paid primarily in salary, or do they have significant equity ownership? Executives with large equity stakes have their incentives aligned with shareholders. Executives paid primarily in salary and bonuses have incentives that may diverge from shareholder interests. Also look at whether insiders are buying or selling stock. Insiders buy for only one reason, because they think the stock is undervalued. They sell for many reasons. But sustained insider buying is a positive signal. Build a financial model. This does not need to be sophisticated. A simple spreadsheet projecting revenues, margins, and cash flows under different scenarios is sufficient. The point is to think explicitly about what the business might look like in 3 to 5 years and what that future business might be worth. Compare your estimate of intrinsic value to the current stock price. If there is a significant gap, you may have found an opportunity. Stress test your assumptions. What happens if revenue grows more slowly than you expect? What happens if margins compress? What happens if the competitive environment deteriorates? Your investment should still work under pessimistic assumptions. If it only works if everything goes right, the margin of safety is insufficient. Think about catalysts. A deeply undervalued stock can stay undervalued indefinitely if there is no reason for the market to re-rate it. Catalysts are events that force the market to recognize value. A new management team, a strategic review, asset sales, share buybacks, a dividend increase, an activist investor, industry consolidation. Not every investment needs an obvious catalyst, but having a sense of what might close the gap between price and value helps with timing and conviction. Consider the quality of the business, not just the price. A truly terrible business can be cheap and stay cheap forever. The business declines, value erodes, and you lose money even though you bought at a low multiple. The best deep value investments are good businesses temporarily mispriced, not bad businesses priced for their badness. Look for companies with competitive advantages, even if those advantages are temporarily obscured by problems. Let me share some examples of the types of opportunities that deep value investing can uncover. Hidden asset situations are among my favorites. These are companies where the balance sheet contains assets that are not reflected in the stock price. Perhaps the company owns real estate carried at historical cost that is worth far more at current market prices. Perhaps there are investments in other companies that are undervalued on the balance sheet. Perhaps there is intellectual property or brand value not captured in the accounting. Hidden assets provide margin of safety because even if the operating business disappoints, the assets provide downside protection. I once invested in a company that owned significant real estate in addition to its operating business. The operating business was struggling, which is why the stock was cheap. But the real estate alone was worth more than the market capitalization. The operating business was essentially free. Even if the operations went to zero, I would not lose money because of the real estate value. That is the kind of margin of safety I look for. The key to hidden asset situations is understanding what assets actually exist and what they are actually worth. Real estate is the most common hidden asset because accounting rules require carrying it at historical cost. A company that bought its headquarters building 30 years ago might be carrying it at $10 million when it is worth $100 million at current prices. The balance sheet vastly understates the true asset value. But you have to do the work to identify this and to verify the current market value. Investments in other companies can also be hidden assets. A conglomerate might own stakes in publicly traded companies that are carried at historical cost on the balance sheet. The current market value of those stakes might significantly exceed the carrying value. Sometimes these investments are obvious and disclosed prominently. Sometimes they are buried in the footnotes and require careful reading to identify. Excess cash and investments on the balance sheet can create similar opportunities. A company might have cash and marketable securities equal to or exceeding its market capitalization. The operating business is essentially being valued at zero or negative. If the operations have any value at all, the stock is undervalued. These situations arise when a company has been struggling and the market has extrapolated the struggles into perpetuity. Some of the parts situations are similar. These are companies with multiple business segments where the consolidated stock price does not reflect the value of the pieces. Perhaps one segment is a great business that would trade at a premium multiple as a standalone company. Perhaps another segment is struggling and depressing the valuation of the whole. If the company could be broken up, the pieces would be worth more than the whole. Sometimes activists push for these breakups. Sometimes management eventually recognizes the value destruction and acts. Either way, the sum of the parts discount provides opportunity. I have seen situations where a company has a dominant business worth $5 billion and a struggling business losing money. The market values the combined company at $3 billion because the losses in the struggling business create headline risk and confusion. But if management would simply sell or close the struggling business, the good business would be revealed in its full glory. The sum of the parts discount is enormous, creating opportunity for investors who can see through the consolidated financials. Temporary problem situations are classic deep value. A company faces a short-term issue, perhaps a product recall, a lawsuit, a cyclical downturn, loss of a major customer. The market extrapolates the temporary problem into perpetuity. The stock price crashes. But if the underlying business is sound and the problem truly is temporary, the crash creates opportunity. You buy when others are panicking and sell when the problem is resolved and the market has recovered its composure. The key to these temporary problem situations is distinguishing temporary from permanent. If the problem is permanent, if the business model is broken, If the competitive position is lost, buying the dip is a mistake. You need to do enough work to have genuine conviction that the problem will pass and the business will recover. This is where the analytical work matters most. Let me give you a framework for assessing whether a problem is temporary or permanent. Temporary problems typically involve external shocks that do not change the fundamental competitive position. A factory fire that disrupts production. A product recall that can be fixed. A lawsuit that can be settled. Economic conditions that are cyclical and will eventually improve. The business itself remains sound even though current results are depressed. Permanent problems involve changes to the fundamental competitive position. A new technology that obsoletes the company's products. A new competitor with structural cost advantages. Regulatory changes that eliminate a profitable business line. Shifts in consumer preferences that are unlikely to reverse. When the competitive position has permanently deteriorated, buying at low prices is a trap because value will continue to erode. Management change situations can be compelling. A company with a good underlying business but poor management trades at a discount because the market has lost faith in leadership. Then management changes. A new CEO arrives with a credible plan. Or an activist takes a board seat and pushes for improvements. The business has not changed, but the potential trajectory has improved significantly. These situations can re-rate quickly once the market believes the new management will unlock value. I pay close attention to management changes because they can catalyze rapid revaluation. A company that the market had written off as poorly managed suddenly looks different when credible new leadership arrives. The same assets and competitive position that were being valued at a discount are now valued at a premium because the market believes value will be unlocked. These re-ratings can happen quickly, generating returns in months rather than years. Spin-off situations have historically been excellent hunting grounds for value investors. When a large company spins off a division, the spun-off entity often trades at an irrationally low valuation. The parent company shareholders receive shares in the spin-off, but often sell immediately because the spin-off does not fit their investment mandate or is too small to matter to their portfolio. This forced selling depresses the price. Index funds that own the parent cannot own the spin-off if it is too small for their index, creating more selling pressure. The spin-off ends up temporarily orphaned, trading well below intrinsic value. These situations often correct within 1 to 2 years as the spin-off establishes its own investor base. The academic research on spin-offs is compelling. Studies have shown that spin-offs outperform the market significantly in the 1 to 3 years following the spin-off. This outperformance is particularly pronounced for smaller spin-offs where the forced selling dynamic is strongest. The opportunity exists because of the mechanical selling by shareholders who do not want the spin-off and index funds that cannot own it. Once this artificial selling pressure ends, prices converge with values. Post-bankruptcy situations offer similar dynamics. When a company emerges from bankruptcy, the new equity is often distributed to former creditors who do not want to own stock. They are credit investors, not equity investors. They sell the stock regardless of price, creating artificial selling pressure. The company emerging from bankruptcy often has a clean balance sheet, reduced debt, and improved operations. It can be significantly undervalued because of the forced selling by former creditors who simply want to monetize their recovery and move on. Let me talk about the psychological challenges of deep value investing, because these are where most people fail. You must be comfortable with being wrong. Not every investment works. Even with excellent analysis, some companies turn out worse than expected. Management lies. Competitors emerge. Industries change. You will have positions that lose money, sometimes significant money. The goal is not to be right on every investment. The goal is to be right on enough investments and to size your positions so that the winners more than offset the losers. I have had investments lose 50% or more despite what I thought was excellent analysis. The business deteriorated in ways I did not anticipate. Management made decisions I did not expect. External factors I could not foresee changed the competitive dynamics. These losses are painful, but they are inevitable. Nobody has a perfect record. The key is to limit position sizes so that no single loss can devastate the portfolio, and to learn from mistakes so you make fewer of them over time. You must be comfortable with underperformance. Deep value strategies do not work every year. There are periods, sometimes extended periods, when growth stocks outperform value stocks. During these periods, You will lag the market. You will feel foolish for sticking with your approach when everyone else is making money in momentum stocks or growth names. The temptation to abandon your strategy at exactly the wrong time is enormous. The late 1990s were brutal for value investors. Growth stocks, particularly technology stocks, soared to incredible valuations. Value stocks languished. Many famous value investors looked foolish and lost assets under management as investors fled to growth strategies. Then the bubble burst. Value strategies massively outperformed in the early 2000s. The investors who had the discipline to stick with value were rewarded spectacularly. Those who abandoned value at the worst time missed the recovery. I remember periods in the early 2000s when I was underperforming and investors were questioning the approach. It is psychologically brutal to maintain conviction when your performance numbers are weak and others are succeeding with different strategies. But the value approach tends to work over full cycles. The periods of underperformance are followed by periods of outperformance. You just have to survive the difficult periods to capture the eventual gains. The psychological pressure during underperformance is intense. You question your analysis, you question your strategy, you wonder if the world has changed and value no longer works. You see others making money easily while you struggle. Every day that you underperform adds to the psychological weight. The natural response is to abandon the strategy and try something else. But this is usually exactly the wrong thing to do. Strategies tend to stop working right before they start working again. You must be comfortable with concentration. A diversified portfolio of 100 positions will produce returns close to the market average. That may be fine, but it is not how you generate exceptional returns. Exceptional returns come from concentration, from having meaningful exposure to your best ideas. But concentration means individual positions matter. A single bad investment can significantly impact your portfolio. This creates stress and requires conviction. The standard advice is to diversify broadly. This advice makes sense for investors who are not doing deep fundamental work. If you do not know which investments will work, spreading your bets across many positions reduces the risk of any single bad outcome devastating you. But for deep value investors who are doing the work, concentration makes sense. You have identified a small number of opportunities where the margin of safety is substantial. Why would you dilute those ideas with positions you are less confident about? You must be comfortable with illiquidity. Many deep value opportunities are in smaller companies with limited trading volume. You may not be able to buy or sell quickly. You may have to build positions slowly over weeks or months. You may not be able to exit quickly if your thesis changes. This illiquidity is actually part of why these opportunities exist. Most investors avoid illiquid stocks, which creates mispricing. But you need to be comfortable with the constraints it imposes. Illiquidity creates real, practical challenges. If you need to sell because your thesis has changed, you may have to sell gradually over time, potentially at worse prices than you would like. If the stock falls and you want to add to the position, you may not be able to buy as much as you want because the trading volume is insufficient. These constraints require planning and acceptance. You cannot trade in and out of illiquid positions like you can with large cap stocks. You must be comfortable with being alone. Deep value positions are often contrarian by nature. You are buying what others are selling. You are seeing value where others see problems. This means you will often be alone in your views. Your friends and family will question your investments. Financial media will tell you why you are wrong. Even other value investors may disagree with your specific positions. You need the confidence to maintain conviction despite the lack of external validation. The loneliness of contrarian investing is underestimated. When you own a stock that everyone thinks is terrible, you receive constant negative reinforcement. News articles explain why the company is struggling. Analysts have sell ratings. Other investors tell you they would never touch it. This constant negativity wears on you. It makes you doubt your analysis. It requires real psychological strength to maintain conviction in the face of overwhelming consensus disagreement. I have found that writing out my investment thesis in detail before buying helps with this. When I can refer back to my original analysis and confirm that the thesis remains intact, it is easier to hold through the negativity. The written thesis serves as an anchor, reminding me why I made the investment and what needs to happen for it to work. Without this anchor, it is too easy to be swayed by the constant stream of negative commentary. Let me address some common mistakes that deep value investors make. Catching falling knives is the most common error. A stock falls and keeps falling. Each new price looks cheaper than the last. Value investors keep buying, averaging down into the position, but sometimes stocks fall for good reasons. The business is deteriorating. Value is being destroyed. What looks like a bargain is actually a trap. The discipline is to distinguish between temporary mispricing and permanent value destruction. When in doubt, wait for the situation to stabilize before adding to the position. I have made this mistake myself. I have seen a stock fall from $20 to $10 and thought it was a bargain, only to watch it fall to $5 and then $2 and then become worthless. Each time I bought, I thought I was getting a better deal, but I was wrong about the business. The competitive position was eroding. The management was not trustworthy. The problems I thought were temporary were actually permanent. The more I bought, the more I lost. The lesson is to be very careful about averaging down. If a stock you own falls significantly, the first question should be whether your thesis is still intact. Has something changed fundamentally? Did you miss something in your original analysis? Is the market seeing something you are not? Only if you can answer these questions satisfactorily should you consider adding to the position. Mechanical, averaging down without fresh analysis is a recipe for disaster. Ignoring quality is another common mistake. Value investors sometimes become so focused on price that they ignore the underlying business quality. They buy terrible businesses because they are cheap, but a terrible business can stay cheap forever. The business declines, value erodes, and the stock never recovers. The best value investments combine attractive price with reasonable business quality. You want good businesses at great prices, not bad businesses at any price. The mathematical reality is that a declining business can destroy wealth even if you buy at a very low price. If a company is losing money and burning through its equity, the intrinsic value is falling every quarter. You might buy at 50% of book value, but if book value is declining by 20% per year, you are losing money in real terms. The cheap price does not help if value is being destroyed faster than the discount provides protection. This is why I emphasize competitive position and business quality alongside price. A company trading at a discount to intrinsic value that has stable or growing intrinsic value is a good investment. A company trading at a discount to intrinsic value that has declining intrinsic value is often a trap. The difference between these situations requires understanding the business, not just looking at valuation metrics. Insufficient patience destroys many value investors. They do the work. They find genuine opportunities. They buy at attractive prices. Then they sell too early because the position is not working or because something else looks more attractive. The returns from value investing come from holding through the difficult periods. Selling after a year of underperformance and missing the subsequent doubling is a tragic outcome that is all too common. I have seen this pattern repeatedly. An investor identifies a deeply undervalued company. They buy at an attractive price. The stock does nothing for a year. Meanwhile, other stocks are rising. The investor gets impatient. They sell the undervalued stock and buy something with more momentum. 3 months later, the original stock doubles as the market finally recognizes the value. The investor missed the payoff because they could not be patient. The antidote to impatience is conviction. If you have done enough work to truly understand the business and believe it is significantly undervalued, you can hold through the difficult periods. If you are not sure, if your conviction is weak, you will sell at the first sign of trouble. This is why the analytical work matters so much. The work creates conviction. Conviction creates patience. Patience creates returns. Excessive trading erodes returns. Every trade has transaction costs. Every sale creates a potential tax liability. Active trading locks in short-term capital gains taxed at higher rates. The deep value approach works best with low turnover. Buy, hold, and only sell when the position reaches fair value or the thesis changes fundamentally. Frequent trading is the enemy of compound returns. The tax impact of frequent trading is underappreciated. Short-term capital gains are taxed as ordinary income, potentially at rates of 35 or 40%. Long-term capital gains are taxed at 15 or 20%. This difference is substantial. If you hold a position for just over a year instead of selling after 11 months, you save 15 to 20% on taxes. Over time, these tax savings compound into significant wealth. Transaction costs also add up. Even with low commission brokers, there are bid-ask spreads, market impact costs, and other frictions that reduce returns. Every round-trip trade costs something. If you are trading frequently, these costs can consume a meaningful portion of your returns. The deep value approach, with its long holding periods and low turnover, minimizes these costs. Anchoring to purchase price is a subtle but damaging mistake. Investors become psychologically attached to the price they paid. They hold losing positions hoping to get back to even. They sell winning positions too early to lock in gains. But your purchase price is irrelevant to the investment merit going forward. The only question is whether the current price is attractive relative to intrinsic value. Decisions should be based on prospective returns, not on whether you will have a gain or loss relative to your purchase price. I try to evaluate each position as if I were considering buying it today. Would I buy this stock at the current price given what I know now? If the answer is no, I should probably sell, regardless of whether doing so creates a gain or loss. If the answer is yes, I should probably hold or even add, regardless of my cost basis. The purchase price should not enter the analysis. Let me give you a framework for portfolio construction in deep value investing. I suggest holding 10 to 15 positions maximum. This provides enough diversification to protect against any single position destroying the portfolio, but enough concentration that your best ideas can meaningfully impact returns. With 10 positions, your average position is 10%. A position that doubles adds 10% to the portfolio. That matters. Position sizing should reflect conviction and margin of safety. Your highest conviction ideas with the widest margin of safety deserve the largest positions. Ideas where you are less certain or where the margin of safety is narrower should be smaller positions. Not every position needs to be equal weight. Keep a cash reserve. Deep value opportunities tend to arise during market stress when prices are falling and fear is elevated. If you are fully invested when these opportunities arise, you cannot take advantage of them. Maintaining a cash reserve of 10 to 20% gives you the ability to act when exceptional opportunities appear. Be patient building positions. In illiquid stocks, trying to buy quickly will move the price against you. Build positions over weeks or months. Use limit orders rather than market orders. Do not chase prices higher. The opportunity will likely persist long enough for you to build a full position gradually. Have a selling discipline. Know in advance under what conditions you will sell. If the stock reaches your estimate of fair value, sell or at least trim. If the thesis changes fundamentally, if you were wrong about the business, sell regardless of price. Do not let positions that have worked become too large relative to the portfolio. Rebalance into new opportunities. I want to be clear about what this strategy can and cannot do. Deep value investing will not make you rich overnight. It will not produce triple-digit returns in a single year. It will not capture every market rally or avoid every market decline. It is a long-term approach that works over decades, not months. What deep value investing can do is produce attractive, risk-adjusted returns over time. It can protect capital during market downturns because you are buying at discounts to intrinsic value. It can compound wealth steadily through a combination of dividends, buybacks, and capital appreciation as prices converge with values. The returns will be lumpy, with periods of underperformance followed by periods of outperformance. But over a full market cycle, the results should be satisfying. The historical evidence supports this view. Academic studies going back decades have documented the value premium, the tendency of cheap stocks to outperform expensive stocks over time. The magnitude of this premium varies by time period and by how value is defined, but the basic pattern has been remarkably persistent. Buying undervalued securities and holding them patiently has been a winning strategy across different countries, different time periods, and different market conditions. Of course, past performance does not guarantee future results. Markets evolve. Information spreads faster than it used to. Competition among investors has increased. Some have argued that the value premium has been arbitraged away or has permanently declined. I am skeptical of these claims. The value premium persists because it requires doing work that most investors do not want to do and having patience that most investors do not have. These human factors are unlikely to change. The strategy requires genuine commitment. You cannot half implement it. You cannot do occasional fundamental analysis while mostly following momentum or listening to tips. The edge comes from doing more work than others and being more patient than others. Partial commitment produces partial results. I have seen many investors try to implement value investing casually. They read a few books, screen for cheap stocks, and buy positions without doing deep fundamental work. The results are usually disappointing. Without the analytical work, they lack conviction. Without conviction, they cannot hold through difficult periods. Without holding through difficult periods, they miss the payoffs. The strategy only works with full commitment to the process. If you are not willing to do the work, if you do not enjoy reading financial statements and analyzing businesses, this strategy is not for you. That is fine. Most people should simply buy index funds and avoid individual stock picking entirely. The low-cost index approach will produce reasonable returns over time without requiring the analytical work that deep value demands. Index investing is a perfectly reasonable approach for most people. You get diversified exposure to the market, minimal costs, and returns that will beat most professional investors over time. There is no shame in index investing. In fact, for people who are not willing to do the fundamental work required for stock picking, indexing is clearly the superior choice. The worst outcome is trying to pick stocks without doing the work and underperforming the index you could have owned passively. But if you are willing to do the work, if you find the analytical process intellectually engaging, if you have the temperament to be patient and contrarian, deep value investing offers a genuine edge. It is the one hedge fund strategy that translates to retail investors. It is how I built my early track record, and it remains accessible to anyone willing to commit to the approach. The irony is that this strategy works precisely because most people will not follow it. They will not do the work. They will not exercise patience. They will chase what is working and sell what is not. Their behavior creates the mispricing that deep value investors exploit. As long as human nature remains unchanged, as long as fear and greed drive short-term market behavior, deep value investing will continue to offer opportunity. Human nature has not changed in centuries. People have always been impatient. They have always chased past performance. They have always panicked during downturns and become euphoric during bull markets. They have always preferred easy shortcuts over difficult analytical work. These tendencies create inefficiencies that patient, disciplined investors can exploit. There is no reason to believe these tendencies will disappear. The market is a mechanism for transferring wealth from the impatient to the patient. Deep value investing is how patient investors claim that transfer. It is not easy, it is not quick, but it works. And unlike almost every other hedge fund strategy, it is something you can do yourself. This is what makes deep value investing so democratic. You do not need a finance degree. You do not need an MBA from Wharton. You do not need to work at a prestigious investment firm. You need an internet connection, access to SEC filings, a spreadsheet, and the willingness to read and think carefully about businesses. The barriers to entry are low. The rewards for those who commit are substantial. It is the only hedge fund strategy that retail investors can truly copy, and the only one where retail investors may actually have structural advantages over the professionals.